Let's take Satish and then we'll bounce back to William's original question. Satish says, I am new to options. I have read many articles where it says that when IV is high, one should sell options, and when IV is low, one should buy. I am trying to understand how much does IV matter in the strategies you guys recommend. Does IV only matter if I want to adjust positions before expiration? Okay. I'm going to walk through 2 or 3 things here. And the first thing is the theory. The theory is, Satish, absolutely. When IV is high, I want to sell into an inflated premium. What we just saw with some of those further out options. Why am I talking about buying a March put to protect the position? Because that's the structure I'd use in a married put. What is the married put structure? Well, it's a bullish position. I'm buying a put that's 5 or 6 months out in time, Satish, and I want the stock to move up naturally. It's a bullish position, but I'm using the far out put to avoid that time decay we just sort of looked at on the shorter term option. I lose less on the longer term option. I have more time for the stock to go my direction. And when I go 6 months out in time to purchase protection, I'm not paying 6 times the cost, Satish, of the current month. I have a lower cost per day buying further out in time. That's why there's that other axiom, Satish, is that when you're selling, you want to sell week by week by week or month by month by month to get a higher annualized potential return. But when I'm buying, I want to buy further out in time to have a lower annualized cost. So, in theory, yes, I want to sell into high IV and buy into low IV. And also the hope is that if I sell into a high IV option, that the volatility collapses, my premium shrinks, and I can buy it back cheaply. Or if I buy into a low implied volatility option, that at some point the implied volatility will increase, which will inflate my premium, and I can sell to close it for a higher profit. That's in theory. In practice, it's a little bit different. Now, I'm going to go to the free webinars link here. It's powerop.com/webinars.asp. And I'm going to go into the options concepts. Later on this weekend, if you have the time, you might want to check this one out. So the website there, powerop.com/webinars.asp. It's a public page. The 5 most recent webinars in each section are only available to subscribers, but you can scroll down here. There's an old webinar that I use. It's from 2014, but I might teach the same thing. Implied volatility, the double-edged sword. Many options investors hear things such as you can't trade without knowing implied volatility. Only sell into high IV. In this position, we break down the effects of IV while sharing what to look for and what to avoid. The comment that you've gotten is correct. In theory, if I'm doing a diagonal calendar spread, Satish, do I have it up here? Yeah. So if I'm buying a slightly in the money call and selling an at or out of the money call, in this structure, it's the poor man's covered call is sometimes called, I want this to have a high IV and the long option that's further out that I'm buying to have a low IV. That's almost impossible to find right now because the options that are past November 3rd have a higher implied volatility. The options I'd be buying have a higher implied volatility due to those options are going to be affected by the election more. The options that expire before that aren't going to be affected. They're going to be affected by whatever things we saw, like we saw today, that caused the volatility across the market to spike 8% this morning. Eventually, I think it still stayed up about 4% towards the end. Okay, so in theory, you're right, but in practice, it's a little bit more complicated. That webinar will help clear it out for you. But I'm just going to take a married put search. And then we're going to look at a bull put credit spread search. The criteria that I use to identify married put positions, here's the one that I just entered yesterday on JD.com. But I think I'm actually in the 85 put, not the 90. Maybe it's not June, it's March. I'm in the March, I think 85, and I bought the stock at 78. Maybe I am in the 90. Ernie did whole logic earlier this week as well for, and there's Logitech that I think William mentioned to me a couple of weeks ago that would have been a good trade. And of course, I mentioned to you guys SAIL, S-A-I-L was a married put I was considering 2 weeks ago. I didn't get into it. Of course, what happens when I don't get into it? The stock spiked 14% yesterday on some news not related to earnings. I missed it. And what do? I get into a position. I should have warned you all that the market was going to drop today for something. I could have told you that yesterday at 2 o'clock. Why? Because I opened a new married put. So the next day the stock has to fall. That's just how it works against me. In any case, here we are. Notice what I've selected, Satish. I've selected the implied volatility. I'm not screening by implied volatility, nor am I screening by delta. Our default search looks for positions that match our stock criteria but have the risk and are not more than 20% in the money, which means that everything goes hand in hand. Without even using delta, this search has already dictated that my deltas are going to be between about 0.48 to 0.65. So pretty limited range without even using delta. Look at my IVs. They're about 0.27 to 0.47. Still a pretty restricted implied volatility, and I'm not even using that in the search criteria because everything kind of goes hand in hand. Oh, sorry, folks. For that case, yes, I want to buy into a lower implied volatility, and these are pretty low. What is a high implied volatility? Let's take a look. Neat function here we have. You can go to the Learning Center under the Home tab, and we can go to Market Activity. And in the Market Activity menu, I'm going to select Optionable Stock Statistics. Now, this page shows me sort of the average of various stock and option criteria. So the average stock last price is 51.68. I think 2 years ago when we checked it, it was at 31. That tells you the last time I remember checking on our webinar, it was 31. We scroll down here, we have the average earnings per share growth is a positive 6%. Average dividend yield is 2.49. The average 20-day volatility and 50-day volatility for stocks is 0.46, and the average implied volatility is 1.07, almost double what I was seeing on those married puts. So what does that tell me? That tells me that that first position that I saw in the married put search on JD, even though it has an implied, I'm sorry, folks, even though it has an implied volatility of 0.46, that might be high for this particular stock at this time. Let's say the average implied volatility might be at 0.35. Here's a good example, American Express. In the heydays 2 or 3 years ago, possibly even January, the beginning of January 2020, when the market was still going lower left to upper right, recovering from a recent pullback, you'd expect things as the banks, such as Bank of America, American Express, Citigroup, Johnson & Johnson, Kraft, would have an implied volatility and a stock volatility of around 0.15, 15%, 0.20, 20%, not 0.366, not 36%, okay? They're all inflated, but these are still relatively low. Walmart, 0.271, usually probably around 0.15, somewhere along those lines. But again, everything further out than November is inflated, even out to 2022, because they're going to be impacted by the earnings. More importantly, they're going to be impacted by that election coming up as well. So I know I'm explaining this, and if I go to my bull put credit screen that I use looking for quality stocks for bull puts that are 2 weeks out in time to get that good return I want, let's say of 12, 15, 17%. Here's some high ones. Wow, Lulu's at 26%. That's pretty high for 11-day, 14-day trade. But let me add in the implied volatility here. I'm sorry. Get out of the way, window. Thank you. Short implied volatility, long implied volatility. Let's add those in for our short and our long options. One of the reasons what I'm doing here, what I'm trying to show you this, Satish. Okay, there we go. So these are all kind of, here's a huge one though, Moderna. I should have expected that. Yeah, Moderna is a monster, and it has had tendency to jump up to 78 because of the vaccine, or it tanked down very far at one point as well, down to 52 or 51, I believe, recently. And this is a deep out of the money 37, 35 strike, but it comes with a lot of implied volatility. But the return is not much better in this structure, is it, Satish? What do I mean? We're seeing ones here with a third of the volatility, a quarter of the volatility, offering an 18% return. Okay, a fifth. All right, that's 0.50 for the short. I should focus on the short, not the long. But that's 4 times less. This is almost at a 200% implied volatility for the Moderna options, and it's a 16.6% return We're looking at an 18.3% return for target on this bull put at a fourth of the volatility. Why? Well, this is a bull put credit spread, Satish. I'm selling one and buying the other out of the money, hoping that both puts expire worthless. In a case of a spread, and I'm thinking a credit spread because I'm taking a credit in, I'm technically selling into this credit spread, Satish, selling the higher 37, buying the higher 35. But what do I have to do in a spread? I have to buy the second one. I'm paying into inflated implied volatility. Would I take a extremely high implied volatility selling deep out of the money? It's almost 40-50% out of the money, a 37 strike on a $68 stock. It's only at 84 cents roughly. Oh, sorry, midpoint's only at 40 cents. Why is this implied volatility so high? It's because Moderna is in a phase 2, if I'm not mistaken. I don't think they're in phase 3. I think they're still in phase 2. They might be phase 1 trial for a vaccine. Now this stock, there it is. It's dropped as low as 54 recently, come back up. Why does this have a high implied volatility? 5 times more than target, 4 times more than target. Why is it so high? Because if their vaccine, their COVID-19 vaccine, fails phase 2 or phase 3 trial, this stock is going to go right down to $20 per share in an instant. Now, if you sold a naked call with a high volatility and the stock falls, you look like a genius. You sell into a high implied volatility for a naked put position and the stock craters, you're in a lot of trouble. That's a lot of loss on the position. If you did a short strangle into earnings, it can be extremely risky. Why? Well, let's say Moderna passes phase 2 and is fast-tracked and passes phase 3 and beats out Johnson & Johnson's vaccine onto the market. This thing could double. I don't want to be short a call in that case just because implied volatility was good and I sold into high implied volatility. And if the wrong happens, I can go and lose severely on this direction as well. So do you want to sell into a higher premium of higher implied volatility? Yes, that would be great. Now ask yourself, why is the implied volatility so high? Because there's a ton of inherent risk on those positions. 2 times and 3 times ETFs that we looked at a moment ago earlier in the presentation. A position that has the potential to drop 70 to 80% of its value if a drug it has in the pipeline fails, or the potential to double in price if it passes. That's not something I want to be short on the wrong side of. Am I saying to buy a straddle or strangle on this? No, it's too expensive. All the options that are at the money or near the money that would make sense for a buying straddle or buying strangle, and they also go against the idea of the higher implied volatility that I don't want to pay into, it's just too risky. Now, I may be boring. I'm not going to ever tell you, and anyone online here, Satish, and anyone who's watched my webinars for years, I am never going to be that options education instructor that says, oh, let's take Moderna right now, ladies and gentlemen. Let's go ahead and look at the option chain real quick. Let's look 2 weeks out in time, 14 days to standard expiration. Look at these incredible implied volatilities here. And let's go to at the money. Look at this. We can sell let's take the 60. I can sell the 60 strike call for 2 weeks out, 10% or more out of the money. Good volatility. Actually, that volatility is not that high. The deep out of the money ones are extremely high, but 84 cents here for a 2-week trade, a 1.2% potential naked yield, I believe, percent if unchanged, and naked yield there, 1.4%. But I'm so far out of the money and I've got an 82% probability. How can I go wrong? Because if I sold a naked put at 60 and this stock tanked down to 35, I'm at a $25 loss per contract times 100. Immense risk. It can happen. And this isn't even as high, but there is the potential that this stock could swing wildly if the drug fails, or if the drug passes, gets fast-tracked and passes phase 3 and gets out before the other ones. Anything that has an implied volatility that high is for a reason. It has earnings coming up, phase 2 or phase 3 trial. There's been recent news that may cause the stock to fluctuate wildly. The implied volatility, Satish, is known also as the measure of fear. fear in the market, fear on the stock because of what could happen if X goes through, Y doesn't go through, earnings are terrible or earnings are great. The known event with the unknown outcome coming forward. Yes, options with higher implied volatility are going to have inflated premiums, so you'd prefer to sell into those or to buy. But ask yourself, why is the implied volatility so high? And do I want to be in a strategy that's directional or short for selling into it if it's taking on too much risk where I could be at 100% loss or an extremely high percent loss as well? Okay. All right. So that's what we're kind of talking about in that case in relation to the IV. Take a look and watch that video. Also, another thing is that you think that, here's a better example, 2-3 years ago, Satish. And when I talked about that webinar, I'm sorry, I'm in the wrong place. When I talked about that webinar I pointed you to there that I want you to take a look at, go to powerop.com/webinars.asp, click on options concept, scroll down to 2014. There's another one, Greeks and why you may not need them, but implied volatility and the double-edged sword here. Watch that video, Satish. Go through it if you have the time. And the reason why is I showed the opposite example there. Well, if we want to buy into the lowest implied volatility at that time 4 years ago, I did an option search for long calls or long puts with an extremely low implied volatility. What was I seeing in my results at the time? Oh, things like GE, Kraft, Johnson & Johnson, which do what? Which have a very high market cap, are blue chip stocks, and tend not, in normal market conditions that we've seen prior, to 2015 and when the great run started, but even a little bit before that, they tend not to move. They have low implied volatility reason because there's no aspect of fear because these positions tend not to move. And that's the case. All right, quickly here while we're here, and then we're going to get to a Williams number one. Fernando says, what is the relation between the implied volatility, that I see on, I want to go back to the chain, I'm sorry. Oh, where was I? That's okay. Let's just do this again. I'll go back to Moderna. There we go. Okay, so Fernando just quickly asked, what is the relation between the IV that we see on common software, for example, Interactive Brokers, and the IV of the single option? I don't know. Okay, if you're talking of, there's 3 forms of implied volatility, 4 forms that we show in PowerOptions. Okay, this implied volatility that we're showing in these data columns when you're looking on the search, it relates just to that particular option, Fernando. Okay. Research. Also, on various tools and PowerOptions, you can see the stock volatility, the 20-day volatility, the 50-day volatility. So what is the volatility of this stock measured over the last 50 days, 100 days, 250 days? Why are these slightly higher? Well, because 100 days ago, we were just coming out of that March range. 250 days ago, we hadn't hit that February-March decline, right? So 50 days ago, it's not looking at that massive decline from February to March where the longer term trends are. It's including that these shorter term trends aren't, although we've had quick movement before. The SIV, it's a stock related, it's called the Stock Implied Volatility Index, but this is based on the average of the in the money and out of the money near term calls and puts. So it's a reflection of how we expect the options around the stock to react, Fernando, based on this. When I talk implied volatility on PowerOptions, it's related directly to the option. If I say SIV, that's sort of a stock measure, but it's the average of the implied volatility of the near-term options. When I say historical volatility or stock volatility, I'm talking about 20, 50, 100. Now, as you know, Fernando, if I'm looking at a specific option, let's just take the at-the-money 69 strike, you can also see the implied volatility range. And this is a terrible example because why? It just expired. Am I on the wrong day? Yeah. I go at least 14 days out, Fernando. My apologies. 69 strike again. Put research. There we go. The IV range is showing you where's the options implied volatility now. 0.6749 compared to where it has been over the life of the option. Since this October 69 strike has been released on Moderna, The implied volatility has moved from 0.6239 to 0.9327. So right now we're in the lower range of implied volatility because it's only at 0.6749. It's closer to this lower range. By the way, Satish, that's one thing that you might want to consider looking at on power options rather than straight implied volatility, is that if I'm looking at an option and I see it's in the lower range of its IV range for where it has been over the life, that's when I might consider buying a lower IV range. If I'm at the 95% IV range, it's near the top. That's also another instance where I might want to sell premium because I'm hoping it reverts back to the normal or goes back into the desired direction. But this does come with a problem. And selling into high IV, of course, can work to the benefit, but remember, you're taking a directional trade. So Fernando, I just wanted to cover that with IV. I don't know their difference. I know what I'm showing, and I'm telling you exactly what we're showing. I don't know how they're showing. Are they showing a percent IV rank? Are they showing a percent IV range similar to what you're seeing here for the volatility, but not the actual hard number? Are they showing you a volatility? Now, implied volatility is typically calculated taking the Black-Scholes value and then working backwards to solve for volatility. In other words, taking the Black-Scholes equation and working it backwards to solve for volatility. If normally Interactive Brokers is using the 20-day volatility in the initial equation or the 100-day volatility, you might not see the same number as power options because we feel confident using the 50-day volatility. Okay, so if it goes backwards there as well, and they're using, so what am I talking about? In the Black-Scholes pricing model, you plug in, as you know, 5 factors to determine the theoretical worth of the option. Stock price, your strike price of your option, days remaining to expiration, of course, that factors in the time premium, current free market interest rates, and what? The stock volatility. You plug in those 5 factors and it spits out a price of where an option should be valued. Okay, let's say it's 235. That's your Black-Scholes theoretical value. But the option is actually trading at 350. Why? Why is it trading $1.20 above its theoretical worth? That's implied volatility. So what do? We take the volatility out of this side of the equation and essentially plug 350 into the answer, work the equation backwards to now solve for implied volatility. But you see the issue there, Fernando. This was a static volatility number used to get the Black-Scholes number. If they're using a 10 or a 20 or 100 or 250-day volatility in that case, then what happens? The original number is off that we're solving backwards for. Okay, and we know the actual price of the option, so the IV should be equal. But again, that volatility they used initially might be different there. Okay, so covered Fernando there. So I was putting together something EAP, and this was before the market fell. I was working on this last night to try to finish it up at EAP. I had 2 coaching sessions yesterday that were talking about buying calls, similar to what we looked at, and the concept of buying in a high implied volatility. I think one gentleman just wanted to look at AMD 85 calls for November, which were about $8. The stock was at 84.84. The November 20th, 85 was $8. And then we had I was working with another customer later on related to implied volatility, but EAP, what is the danger of buying calls or puts in this market? And we've sort of covered some of it. But are we trending up? Are we trending down? Remember earlier in September, we were down. This is over here on the left, of course, is your September SPY. And we had that dip starting on September 3rd, but then we started to come back up. And then today, the unexpected happens. Are we trending down? Are we trending up? Well, we were starting to look like we were trending back up. And then the unexpected, something we didn't want to hear happen, happened. With the infection of the president and the first lady, of course. No one wants to see that. No one wants to hear that. Doesn't matter what your politics are. We don't want that for anybody, but it's been going on. So beware of the events. What do we have? What is EAP? Well, it's a figment, an expression, but also EAP is beware the events. We're going into earnings season, okay? The market knows that it's coming. Stocks could swing one direction or the other based on the results of those earnings. That volatility is going to be factored in. We saw on numerous amounts of times today November 20th options, December options. I showed January options. We looked at April options where the implied volatility is higher in April and December and January than it is right now in October and the last weekly cycles of October. Why? Because of the election. The market knows this event is coming. The outcome is unknown. Similar to earnings and the pandemic. Are we going to see a vaccine? Are we going to see a second stimulus? Is Europe effectively, yes, it is, in a second wave? Are we here in the US even a second wave, or is this something that's just continuation because the first wave never really went away? It's just finding new pockets. We're not trying to make light of it. This is investors is what we need to know. This is why the volatility is skewed. When you look at a volatility skew and you're doing a diagonal spread, I want to buy into lower implied volatility for that call or put that's 4 or 5 months out. And I want to sell into higher implied volatility, which you can normally find. We can't find that right now because of these 3 factors. Other factors too, but these are the 3 main ones. All right. Really, the earnings one is the main, the election one, excuse me, is the main one. My apologies there. Earnings are a wild storm. Your stock can beat expectations, but it falls because the outlook going forward is bad. Your stock misses expectations, but rises because they didn't miss by as much as they were expected to, or the future outlook for the next quarter is raised. So, hey, we're bad now, but next quarter is looking great. So it's going to go up even though they missed expectations. Your stock beats expectations, but only has a minus or plus 2% move. Didn't have as much move as you were expecting, but you get the volatility decay. That's great. Your stock beats or misses expectations and moves as you expect. That's great. But it's all over the place. You could miss expectations and see a 1 or 2% move. You could beat expectations, see a 1 or 2% move. You can beat expectations and see a 15 to 20% move. Miss expectations and see what we had expected, a 20, 25% move. Okay? That's what we're going into. We're in, but we're going into also as well. Election year. Who will win? No one knows. And of course, I always go to the feed those hungry hippos, the old ads from the 80s, you know, when I was 10, 11, 12 years old. You always had that commercial for hungry, hungry hippos. Who will win? No one knows. Feed those hungry hippos. But win or lose, yes, we don't get political. We all have our own candidate that we want to win and who we've probably already decided we're voting for in most cases. We want to keep an open mind, but we know pretty much where we're going in the polls. All of us do. We're not going to get into that. But what matters to us as investors is win or lose is the money that we have in the market, protecting the money that we have in the market for an unknown outcome. And at the same time, of course, putting ourselves in new structures, whether they're high implied volatility, Satish, or low implied volatility, in a direction where we're not over trading, we're practicing proper position sizing, and we're hopefully in the right direction, but not taking too much exposure by doing that as well. And the third thing, of course, we're still in a pandemic. There's surges in Europe, questions in the US. I just chose the sharks here. I'm going to address that in a minute, William. But we can't see it. We know it's out there. It's lurking. It can still affect us. I always encourage you, as Sam always encourages us every Friday, is remember to stay safe, wear your mask, wash your hands, social distance as well. There's fear across the market. And I wrote this last night at 11:30 before the news broke, but it doesn't matter what any politician says. In the end, what is important to you as an investor, that this is out there. This is affecting the economy. This is affecting individuals. This is affecting families. This is affecting bottom lines of people who can't work right now or can only work half of what they could before. And that's important to us to know going forward, those 3 things. But the election is the big one. And those 2 other factors, that pandemic factor is going to weigh heavily, of course, on the election. And uncertainty, that fear that Satish brought up to us, leads to profits and losses. Here's the customer the other day, AMD at 84.86. The 85 AMD call, 58 days out in time, is priced at $8. And he says, I'm interested in trading this 85 call. It's an $8 contract, so the break even on the long call, if he just bought the call, is $93. That's a significant move, 9%. And he's bullish on the stock, but what could go wrong? Well, okay, what is going on? This seems high. Why does it seem high? November 20th expiration. The SIV is in line and the volatility is in line with some of the other things we saw. 0.579, 0.67, a little bit more than half of the average we saw from the learning center. The average implied volatility in SIVs are about 1.07. The average 50-day stock volatility was a little bit lower. So AMD is a little bit above that. It's been a good mover. It's been a strong mover. Lower left corner, options research tool. It's in the center section, but I just cropped it here. Earnings, 10/27. So this November 20th series is going to be affected by earnings on 10/27 and going to be affected by the election on November 3rd. What did we talk about the three outcomes of earnings? How could this hurt? His stock, AMD, beats or misses expectations on 10/27. Yeah, it's unconfirmed now, but it's going to be around there. It meets or beats, and the stock only moves 2%. What's going to happen after that earnings, even though the election is coming up a few days away? More than likely, this implied volatility of 0.6385, close to the 50-day volatility of the stock, after that earnings on 10/27, if he hasn't closed the position or realized the profits yet, if it only moves 1 or 2% up or 1 or 2% down, this is probably going to go back down to 0.45, 0.5. Go back to this range and the 20-day volatility. It's going to drop, not necessarily by half, but it's going to decline drastically. Why is that a problem? This is an at-the-money option that is all extrinsic value. There is no intrinsic right now. He would pay $8 into time premium. That goes down to 0.45. This is going to drop almost by half. The time value is going to drop by almost in half. This might go down to $4. And he's lost 50% of his value with the stock only moving 1 or 2%. Now, the hope is maybe implied volatility still remains somewhere in there because the election coming up 3 days. But let's say AMD stays between 86 and 84 after the earnings. The volatility drops down to 0.43. Then we go into the election. The market drops down based on the results, goes down to 82, 83, but then comes back up to 84, 86. Or it goes up to 88, and then it comes back down to 84, 86. Now you've got 17 days to expiration. The earnings is gone. The election is gone. This volatility is probably going to be in half at that point. It would not surprise me to see it 0.35, 0.32, or 0.33. Even though AMD has been a rocket ship, now everything is alleviated. There's a sigh of relief. Those farther out options are going to drop in implied volatility too, the ones we talked about, December, January, February, after that event. But if he doesn't see his profit on AMD before that event that matches his targets and he holds through the event, he's going to suffer volatility collapse. And then 3 days later, potentially another volatility collapse after the election. So if AMD does go up before, the position could win, assuming IV stays the same around that 0.64, 0.63 range. But after earnings, we're going to see it fall. In this case, we need to get more of a move. What do I mean by more of a move? Well, he knows that the break even's at 93. But if volatility stays the same at 0.63 or 0.64, and he sees AMD prior to the earnings go up to 87 or 88, he's going to have a profit. It could be as high as maybe a 30 or 40% profit. But he can have a profit. And if the earnings don't move the stock, he still has $8 of time value he needs to cover. The volatility drops down to 0.43. He loses $4. Now he needs more of a move because there is no more inflated time premium. He needs the stock to be at 93 now to make a profit. He needs to be at 92, not 87, not 88. Okay, so that's what we were talking about here. And this isn't finished. There we go. That webinar is not finished in this case. I just put up those slides, and then there's more to come after that.